Greetings, everybody. Welcome to the Liberty Calls weekly wrap-up for December 9th, 2022. Hope everybody's having a good day out there. Not the best day in the markets. See a lot of red here domestically, but mostly green for the international market. So I guess all in all, not the worst day in the world, but is what it is. Again, we'll look at the markets for today, go over the economic data that came out this week, the weekly or the daily wrap up of what happened in the markets. And why is everyone talking about the Fed pivot? I mean, I know I've stressed this a lot in recent, pretty much all year. The financial journalists and the people out there are just chomping at the bit to start lowering interest rates. But it's like, why? I mean, yeah, it's painful if you're, buying a house right now and, if you're borrowing money, but, we got to get this inflation under control. And until that occurs, we're kind of putting the cart before the horse. But before we get started, let's give me some big old thumbs up. I'd really appreciate it. Like, share, subscribes, all that good stuff would greatly be appreciated. So let's go ahead and jump into the numbers. Dow Jones finished the day down 0.9% at 33,476. S&P 500 was down 0.74, closed at 3934. NASDAQ was down 0.7, closed at 11,004. Small caps were down a little more than 1.25. The VIX was up again today, 2.42%, closed at 2283. Let's see, Canada was down 0.11. Brazil was up 0.36. Mexico down 1.25. European markets, Germany was up 0.74, UK was up 0.06, France up 0.46, Euro stocks was up 0.54, Netherlands was up 0.6, Italy up 0.29, Switzerland up 0.58, and Portugal up 0.11. Russian exchanges were split today. MOEX was down 0.3, the RTSI up 0.23. And the Asian markets overnight, Japan was up 1.18, Australia up 0.53, New Zealand down 0.08, so basically flat. Chinese markets were all green. Shanghai was up 0.3, the SCSE component up 0.98, China A50 up 1.38, DJ Shanghai up 0.47, Hang Seng up 2.32, and the Taiwan weighted up 1.05. So, like I said, mostly greens across the rest of the world, but here domestically, again, I think a lot of it has to do to some economic data that came out this week regarding the PPI, the Producer Purchasing Index, was higher than what people would like, and I think that gives a clue that the Fed is not going to be able to pivot as quickly as they would like. But, it is what it is. It's at this point, we really need to get the problems under control before we start, counting our chickens before they hatch. So, all right, well, let's go ahead and look at the indexes for the week and see how they performed. Let's see here. The Dow Jones is going to finish the week off down about 2.5%. The S&P 500, a little more than that at about 2.93% down. NASDAQ is going to finish the week down 3.16. The Dow Utilities looks like it's going to finish up for the week about 0.29. And the Dow Transports, let's see here, down 4.88. So that's the worst of the lot right there. So it looks like only the Dow Utilities finished the week in the green. So let's take a look at the longer term trend. Let me back out of here so we can see, turn my charts back or my lines back on. We can see here again, starting at the beginning of the year, the downtrend. And like I talked about last week, my assumption was we would bounce off this line of resistance, which we've done on two separate occasions in, late spring and then again in the late summer. And, it seems like we go a few months, we have kind of a downturn, we have a nice rally, and then it loses steam when we hit that. Now with the Dow Jones, it has broken through on two separate occasions. That late summer rally broke through but lost steam. And same thing here on this rally that started in late October. But again, it looks like it's losing steam. Looking here at the momentum indicator, it's crossed back into the red down here. So I would assume it's probably going to fall back below, and we'll probably test because each one of these we've had a lower low each time we've had a downturn in in each of these markets. So again, we'll see what happens over the long term, but that's kind of my, until the trend changes, I would be careful with your portfolios out there, adjust accordingly. If you need some help with that, I know somebody who can help you, this guy. So feel free to reach out to me if you need some guidance on that. So, all right, well, let's go ahead and get that chart out of the way. And let's go through the economic data that's out this week. Starting out with jobless claims. Initial jobless claims came in at 230,000, right on forecast. A little higher than last week's number of 226. And but still, not too bad. We've had higher numbers through August and July. So again, I'm not too worked up about it. But again, the jobs numbers are a lagging indicator. So typically businesses are going to have a tough time before they actually start laying people off. Continuing claims ticked up. We're at 1.671 million. The forecast was 1.6 million. So it went up from last week's number about 52,000. Again, looking back at the historical trend, still not terrible. We're about at the same number we were at in February, late January. But again, still not, we had really record low, jobless numbers, through this year. So again, I wouldn't get too worked up about that. The Purchasing Managers Index came in at a 46.2. The forecast was 46.1, so slightly above forecast. But keep in mind, any reading below a 50 shows that things are typically falling or a sign of weakness in the economy. Factory orders month over month came in at 1%. Forecast was a 0.7, so a little bit better than forecast there. So that's a bullish sign. The U.S. trade balance, not something I don't get too panicked about. I know some people get real freaked out about the trade imbalance. If we look back at the historical trend, it's, this goes back to the 80s and 70s. It's certainly far worse than probably people would like, but we have seen some improvement from, I guess, what was this? April was the worst month. And, we had ticked up through, I'm sorry, that wasn't April. That was May. But we kind of peaked here in October, and it's been slowly sliding back down over the last 2 months. So again, we get goods from elsewhere, and we send them our worthless dollars that we keep inflating year after year. So the Producer Price Index year over year came in at a 7.4 number. That's, this is the real thing that's given people a lot of heartache this week. The forecast was 7.2, so it came in higher than forecast. Last month's reading was an 8.1, so it did come down from last month's number. But if we look at the month-to-month number, we grew at a 0.3% over the last month, same as the month before. We had a few months back here in August and September where we actually were, gaining some ground on the inflation in this index, and but the last 2-3 months we've had positive numbers, which yes, the yearly numbers coming down, but it's still growing, but just at a slower rate than what we had here in the latter half of 20 and then all of 21. Consumer sentiment came in at a 59.1. Forecast was 56.9. So well above the forecast number, and certainly above the number from last month of 56.8. So I guess people are feeling better. It's the holiday season. Maybe they've been drinking their eggnog and they're spiking it with a little rum, and they're thinking, hey, things aren't as bad as they could be. So anyways, and, it's not the end of the world. Life will go on. If we could certainly get a lot of government and regulation out of our lives, I think things would be moving a lot better. So, all right, well, let's go ahead and read through today's, market recap. Wall Street mixed as investors digest economic data. Wall Street was mixed on Friday as investors assessed economic data and awaited a potential 50 basis point interest rate hike by the U.S. Federal Reserve at its policy meeting next week. U.S. producer prices rose slightly more than expected in November amid a jump in the cost of services, but the trend is moderating, with annual inflation at the factory gate posting its smallest increase in 1.5 years, data showed. Quote, it's not the end of the world, but certainly a negative surprise for the markets, end quote, said Peter Cardillo, chief market economist at Spartan Capital Securities. Quote, bottom line is inflation is in a downtrend, but month on month, it's hotter than expected. Markets always look at the monthly top line, end quote. However, in December, consumer sentiment improved while inflation expectations eased to a 15-month low, a University of Michigan survey showed. Futures trade suggests a 77% chance that the Fed will raise interest rates by 50 basis points next week, with a 23% chance of a 75 basis point hike, like they've done the last 4 or 5 meetings, with those odds little changed after Friday's economic data. Consumer prices data for November due Tuesday will provide fresh clues on the central bank's monetary tightening plans. Lululemon Athletica tumbled 13% after the Canadian athletic apparel maker forecast lower than expected holiday quarter revenue and profit. Netflix gained 4.9% after Wells Fargo upgraded the video streaming giant to overweight from equal weight. Wall Street's main indexes have fallen this week after logging 2 straight weekly gains. Weighing heavily on investors are fears of a potential recession next year due to extended the central bank's rate hikes. U.S. stocks ended a recent run of losses on Thursday after data showed initial jobless claims rose modestly last week, suggesting the labor market was deteriorating. Of the 11 S&P 500 sector indexes, 7 declined, led lower by energy, down 1.76%, followed by a 0.55% loss in healthcare. The energy index was on track for a 7th straight session of losses, its longest streak since December of 2018, as oil prices looked set for weekly losses on concerns about a recession. Broadcom Inc. jumped 3% after the chipmaker forecast current quarter revenue above Wall Street estimates. Boeing Company was up 0.4% after Reuters report the plane maker plans to announce a deal with United Airlines for orders of 787 Dreamliner next week. Declining stocks outnumbered rising ones, with the S&P 500 by a 1.3-to-1 ratio. The S&P 500 posted 5 new highs and 1 new low. The NASDAQ recorded 39 new highs and 154 new lows. All right. So again, not all bad news, but certainly not great. Again, a lot of this is self-inflicted, but that is what it is. All right, let's move on to the producer price index. U.S. PPI accelerated unexpectedly in November, frustrating hopes for a quick pivot. And the next article will have to do with the Fed pivot. U.S. producer prices rose faster than expected in November, in another sign that inflation isn't coming down as fast as the Federal Reserve would like. The producer price index rose by 0.3% from October, more than the 0.2% consensus, and October's numbers was also revised up to 0.3 from 0.2. The picture was flattered by volatile food and energy prices. With those two elements, the core producer price index rose 0.4%, the most since June. That left the core year-on-year rate of factory gate inflation at 6.2%. While that's the lowest reading in over a year, the result of big increases in energy prices last year passing out of the equation, analysts had forecast a steeper decline to 5.9%. More recent developments in the energy markets also helped, with gasoline prices down 6% on the month. The headline PPI rate similarly declined only to 7.4% from an upwardly revised 8.1% in October. Analysts had forecast a slowdown to 7.2%. Analysts said the broad trend of disinflation in traded goods was still intact. However, in year-on-year terms, all the main sectors of the index are falling, with the exception of wholesale food prices, tweeted Charles Schwab's fixed income strategist Kathy Jones. The Bureau of Labor Statistics said that the most of the impulse for November's data came from the final demand services, with financial services accounting for 1/3 of the total gain in services prices. It noted that service providers' profit margins expanded by 0.7 percentage points, fresh evidence that corporate pricing power has contributed largely to overall inflation this year, besides the better documented narratives of high energy and labor costs. U.S. stock futures reacted negatively to the news, which was seen as making it harder for the Federal Reserve to slow and then stop this year's sequence of interest rate increases. After a strong labor market report for November, market participants expect the Fed will raise rates above 5% to bring inflation down decisively. Again, should have probably done this a lot sooner, but, no one wants to crash the market and mess up their portfolios. But hey, so we'd rather have this slow Chinese water torture trickle to solve all the problems. All right, last article I got for today, why investors are obsessed with the Fed pivot. And I know I've pointed it out that a lot of these journalists seem to really dwell upon the when they're going to start lowering rates, when they're going to pivot, as opposed to let's get the problem solved before we start worrying about that. And this was written by Daniel LeCale, and this comes from Mises Wire. All right. In a recent Bloomberg article, a group of economists voiced their fears that the Federal Reserve's inflation fight may create an unnecessarily deep downturn. However, the Federal Reserve does not create a downturn due to rate hikes. It creates the foundations of a crisis by unnecessarily lowering rates to negative territory and aggressively increasing its balance sheet. It is the malinvestment and excessive risk-taking fueled by cheap money that led to a recession. Those same economists probably saw no risk in negative rates and massive money printing. It is profoundly concerning to see that experts who remained quiet as the world accumulated $17 trillion in negative yielding bonds and central banks' balance sheets roared to more than $20 trillion now complain that rate hikes may create a debt crisis. Again, I've been pointing this out all year. The debt crisis, like all market imbalances, was created when central banks led investors to believe that a negative yielding bond was a worthwhile investment because the price would rise and compensate for the loss of yield. A good old bubble. Multiple expansion has been an easy investment thesis. Earnings downgrades, no problem. Macro weakness, who cares? Valuation soared simply because the quantity of money was rising faster than nominal GDP. Printing money made investing in the most aggressive stocks and riskiest bonds the most lucrative alternative. And that, my friends, is massive asset inflation. The Keynesian crowd repeated that this time would be different, and consistently larger quantitative easing programs would not create inflation because it did not happen in the past. And it happened. Inflation was already evident in assets all over the investment spectrum, but no one seemed to care. It was also evident in replicable goods and services. The FAO Food Price Index already reached an all-time highs in 2019 without any supply chain disruption excuse or blaming it on the Ukraine war. House prices, insurance, healthcare, and education, the bubble of cheap money was clear everywhere. Now, many market participants want the Fed to pivot and stop hiking rates. Why? Because many want the easy multiple expansion carry trade back. The fact that investors see a Fed pivot as the main reason to buy tells you what an immensely perverse incentive monetary policy is and how poor the macro and earnings outlooks are. And let me skip down here to basically how to solve this problem. To cut inflation drastically, three things need to happen, and only one is not enough. Hike interest rates, reduce the balance sheet and central banks meaningfully, and stop deficit spending. This is all unlikely to happen anytime soon. So there are a lot more details in here if you want to read through the rest of the article. It is, it's not too much longer, but I have attached to the show notes. So if you want to read that at your leisure, please do so. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastic weekend, and I'll talk to you guys next time. Bye-bye.